Welcome for
Your voice is breaking.
Vishal, there is some issue.
You are not audible, huh?
Vishal. Vishal.
Vishal sir. Am I audible, Jitu sir?
Yeah. Now. Vishal.
I think now you are audible.
Vishal, you can continue. Hello.
Hello, Jitter.
Hello. Vishal is.
Hello, Jitu sir, are you there?
Yes, Vishal.
Now am I audible?
Yes. Please go ahead.
Okay, good evening. Welcome for a virtual study course on tax audit. Today we are having session on ICDS and 11 provision under the Impact Act. For that we have faculty CA Rajendra Agiwal sir. I request CA Jitendra Fafat sir to introduce today's speaker.
Thank you, Vishal sir. It is my proud privilege to welcome Rajendra Agiwal sir for today's seminar in our endeavor of Nashik branch to on our 5 days tax audit seminar, virtual seminar. This is our third seminar today. So for which we have a very learned faculty today, Rajendra Agiwal sir. Just for a formal introduction, he is born and brought up from Jalgaon in our nearby area, and more important, he has completed graduation from our own BYK College of Commerce, Nashik, 1982 batch. He was a senior partner in Rajendra Agiwal and associate up to 2008. His core area of practice is direct tax. Till 2008, he was mainly looking after clients in machine and machine tool industries, leasing and finance, investment companies, audit of cooperative banks, cooperative societies, then audit of nationalized bank, concurrent audit, and etc. In 2008, he joined EY. Now he is occupied with SRBC, an associate affiliated firm of EY, as advisor direct tax. Work profile mainly includes and advisory matters. Request to then corporate tax matters, transfer pricing and international tax of software companies, real estate sector, manufacturing companies, service industries, and experts individual taxation. He is a life member of PCAS, BCA, Chamber of Tax Consultant Mumbai, and also he was secretary of Pune Income Tax Appellate Tribunal Bar Association in 2017-18. He was also a managing committee member of Pune branch of WRC in 2007 to 2010. During this period, he was a treasurer in 2007 and 8. He was also awarded RT Doshi Foundation Award for article written on taxation of charitable trust in year 2008, which was published by PCAS. He has actively participated in all conference refresher course organized by PCA, BCA, and CTC. He has delivered various lectures in CP program organized by various branches of WRC like Pune, Nashik, Jalgaon, Kolhapur, etc. With this brief introduction, I welcome Agiwal sir for today's session, and now the mic is yours. We are just, everybody is waiting to hear Agiwal sir.
Thank you, Jitendra ji. Am I audible?
Yes, sir. Very much. Thank you, sir.
Thank you for kind words of introduction. As you have read in my profile, I am having a extraneous attachment for Nashik city because my golden period of life, that is SY and TY, I spent on Sharanpur Road near CBS.
Great,
I
sir.
graduated from BYK College of Commerce.
Yeah.
One more great connect with the Nashik is that you have read that this RT Doshi Foundation Award on Charitable Trust.
Correct.
It was my first paper presented at Nashik.
Oh, great.
And that same paper was published by the PCS, and then I got awarded for that. So that is another strong memory connected with the Nashik. So
Yes, sir.
I am always very affectionately look at Nashik. Still I remember that Tushar Misal Pav and Sayantara Sabudana Vada and all that.
Great, sir. Great.
It is the different thing that Jitendra ji is never calling me right now to enjoy this menu. But,
Definitely,
no,
sir. It
but
will
no,
be our privilege to call you, sir, physically.
yeah, so probably this meeting would have been kept in a physical mode. I would have enjoyed those dishes.
Yes, sir. We will try our whenever there is there, we will call you, sir. Sure.
Yeah, so I will carry forward this balance for the next
Yes, sir.
session.
Yes, sir. Yes, sir. Surely, sir.
Many of my gurus like Rahakar sir, RC Gujarat, late RC Gujarati sir, Sarang Pani sir, all the accountancy and tax is embedded in me from Nashik only. So
Yeah.
that is the history of Nashik for my professional life is concerned.
Great, sir. Great, sir. Thank you so
With
much.
this Yado ki Barat kind of thing, let me move to the my topic proper. The topic is allotted to the ICDS, Income Computation Disclosure Standards, and relevant provisions of the Income Tax Act from the tax audit point of view. That was communicated to me. So with this ICDS, when we say that ICDS standard, means immediately we recall the accounting standard. And I'm not into the audit practice nowadays. After joining the UI, mainly I'm concerned with the direct tax litigation. So initially, when I got a call from the Nashik branch, I was a little bit afraid what I will speak on the ICDS. Then when when I saw that it is linked to the tax audit report, then I thought that I could make something out of that. And in any case, it is a opportunity for all of us to share our knowledge and wisdom, and that will also be beneficial for me. So with that perspective, I accepted this assignment, and I thank the Nashik branch and organizers for giving me the opportunity of sharing my knowledge. With this, let me turn to the topic. We are not going to discuss the ICDS, exactly what is the disclosure, what is the scope, terms, etc. In generality, we will discuss what is the concept of ICDS, and is it to what extent as a tax auditor or while filing the return of our clients we have to take care, or what issues can be faced in the assessment and how to prepare for that. So it's an overall attempt from all angles. So let me see to what extent I succeed in presenting this. With this, are you able to see my presentation?
Yes, sir. Yes, sir. Just if you can do it full screen so that.
Yeah, so now full screen, I'm just trying to figure out how I can make it full screen. Just a minute, stop for now. Because I'm not that much techno savvy.
I am also not able to.
Because normally after pressing the
Actually,
F5,
sir, there is a power issue, sir. Power issue, sir.
Pardon?
Power issue, sir. The light
Where
is.
no, we can see the slide. I can see the slide. Others, can you just check if slide is visible?
Yes, sir. Slide is visible.
but it is, I'm not able to convert it into full screen. Normally by pressing the F5, just a minute. पापड़ जी मेरे को इधर कोई ऑप्शन नहीं दिख रहा है.
Okay, sir, let's continue. I will also search and then let you know, sir.
Yeah. Just a minute. In fact, just a minute. Is it full screen now?
Yes, sir. Yes, sir. Yes, sir.
Yeah. Right. So let me proceed with the my presentation. I'll just touch upon the brief history of the ICDS. Section 145, first time it was amended in 1995. So by that amendment, the power was given to the central government to notify the accounting standard which is to be followed in the for the purpose of taxation. That was to be followed for any class of the taxpayer or in respect of any class of the income. That was the idea. So in the 1995, there were only 2 accounting standards which were notified somewhere in January 1996. The first accounting standard was nomenclature was given was a accounting standard only. So it was accounting standard 1, disclosure of accounting policies, and accounting standard 5, that is disclosure of prior period and extraordinary items and changes made to the accounting policies. So please note here, as again the today's nomenclature of ICDS in 95-96, when the idea was first time it was coined, and this idea was coined, at that time the nomenclature used was only accounting standard only. Now in this current scenario, they have changed this terminology, and now it is called the income computation and disclosure standards. Therefore, for that purpose, the committee was constituted for formulation of the ICDS. In July 2002, the committee was constituted for formulating ICDS recommended by the ICAI. And it was to be notified for the purpose of Income Tax Act with certain modification, without any modification. Later on, the central government decided to converge these ICAI prescribed accounting standard to IFRS. Then again, a new committee was constituted somewhere in December 2010, and that committee was allotted the task to study the harmonization of the ICAI accounting standard with the Act and suggest the changes for the ICDS, or suggest the income computation disclosure standards. To suggest those methods for addressing the MAT issue in a transitional previous year from convergence to IFRS, because there will be impact on the book profit. And you know the MAT is leviable on the book profit as per section 115 JB. So that was one of the bullet point for before them. And then to suggest the appropriate amendments in the Act in view of the translation from transition to Ind AS. So, in light of this background, the final report of the committee has come up a fresh draft report with 14 ICDS. That is the brief journey so far, 95, 96 to 2010. Then again in section 1, but nothing was formalized. It was a continuous discussion was going on. And therefore, first time the section 145.2 was amended by the Finance Act 2014. It was stated in the section 145 subsection 2 to replace the term accounting standard with the income computation and disclosure standards, which is our current today's topic. So first time the amendment was made by Finance Act 2014. In March 2015, 10 ICDS were notified, which were supposed to be applicable from AY 16-17, and earlier two standards which I referred in the first slide which were notified in the 1996 are superseded by these 10 standards, 10 accounting standards, ICDS standards. Then somewhere in February 2015, again the final bill was amended to align the Act of ICDS. In July 2016, after considering the stakeholders' comments in the draft report, etc., the Central Board of Direct Taxes issued a press release that this ICDS is to implement ICDS is facing a difficulty by the stakeholders, and therefore the press release declared that they're deferring this implementation of the ICDS, which to be applicable from AY 17-18, that is financially 16-17. And then we came to the end of the journey that in the September 2016, the revised ICDS were provided to us for the purpose of compliance. Then the CBDT has issued certain clarifications in the form of the FAQs. These FAQs can be referred whenever required when we face the difficulty for implementation of the ICDS, and that for purpose a reference can be made to the CBDT circular number 10 of 2017 dated 23rd March 2017. Now below this slide, if you see, I have raised one poser. Is there any rationale that ICDS are made applicable only in case of SSE following the mercantile system of accounting? Just I'm parking this this poser. I will come back to this. So my question is, this is made applicable only to the SSE following the mercantile system of accounting. That means it is not made applicable if the income is computed under the by following the cash system of accounting. Now you are aware when this ICDS were declared with this notification and preamble and scope with the various terms and treatment to be given to the each item like government grant, then borrowing cost, etc. It was on the analysis of this ICDS provisions, which was a part of the section 145.2, that it will unsettle the legal position. You are aware that on all these issues, like allowability of interest under the Income Tax Act, accounting of the government grants, recognition of revenue, etc. There are then foreign exchange, allowability of the foreign exchange, whether it's a revenue or capital, whether mark-to-market losses are contingent liabilities or not. So several claims under the Income Tax Act, the day in and day out, when we face these issues, you can recollect, or that the senior members who are practicing in litigation and exclusively practicing the income tax side, probably they are aware and they will agree with me that all these issues were settled by way of the landmark judgments of the Supreme Court and the various high courts. Forget about the tribunal decisions. So it was felt that this ICDS may create a problem and it will settle the legal position, which is very settled. It will make the unsettled and it will create a problem or increase the litigation. That was the analysis at the end of the professionals. With this background, the Chamber of Tax Consultant has taken a very challenging move, and this ICDS draft was challenged before the Delhi High Court. This was the writ petition number 5595/2017, where the validity of the ICDS was challenged. It was argued by the from the chamber side. The matter was represented by the senior advocate, Mr. Ganesh. And when the matter had come up before the Delhi High Court, there were the three questions which were posed before the High Court. And what was those questions? The question or the ground on the basis of which this ICDS were challenged before the Delhi High Court. Question number one was whether there is an excessive delegation of power to the central government and consequently CBDT to make the amendment in the law by virtue of amendment in section 145(2) by giving authority to notify the ICDS. Because what they have done, that they have delegated the power to notify the ICDS to central government, and central government further delegated that power to the CBDT, and those ICDS were made the part of section 145(2). So effectively, it was argued that this notification of the ICDS and making a part of section 145(2) by delegating the power to the central government and again to the CBDT, it is in effect the change in the law. And you are aware that law can be changed only by parliamentary process. When the bill is presented in the parliament and the bill is discussed, and then it is approved by the Lok Sabha and Rajya Sabha, and when the assent is given by the President of India, then that can be said to be a law. So by implementing the law in the form of the ICDS or in the guise of this ICDS, by amending section 145 by way of such a delegation of power, it was felt that it is not a valid procedure. It is not known to the parliament. It is not known to our constitution. And therefore, it is sort of the excessive delegation of the power to the central government. And when I was reading this judgment yesterday, I found that the Honorable High Court has appreciated that argument and said that this is not the correct procedure. Then the second question which was posed before the High Court was whether the ICDS is disregarding the settled judicial principles, which I have just spoken right now. For example, taxation of retention money in the case of the contractors. And many of us, many chartered accountants, when we were auditing the accounts of the civil contractor or filing the returns or facing the assessment, in the past, there was a lot of debate whether the retention money which is not received or realized by the contractor, which has been held by the contractee for the specific performance of the contract or on the part of the warranty and guarantee of the contract, that retention money will be considered as income only when it is realized. And there are several decisions on this point. Further, on the part of the valuation of inventories, it is recognized principle that inventory has to be valued at a cost or market price, whichever is lower. Further, there was a settled principle in the case of the ALA firm and subsequently followed in the case of Sakti Trading Company. Both the citations you will find in my next slides, that if there is a the continuation or discontinuation of the business, how the stock is to be valued. So there was a clear-cut position settled at the hands of the Supreme Court that how to value the inventories in such a scenario. As compared to the judicial precedent, the wording was discompatible in the ICDS. ICDS was not taking any cognizance of this decision, and the language has been used was creating a problem. And so it was argued that it is unsettling the settled judicial precedent. That was another question before the, and therefore on that ground, this ICDS needs to be quashed. That was the another question. And third and the last important question was whether these ICDS are constitutionally valid from the perspective of Article 14, Article 19 1G, Article 141, 142. Article 14 talks about equality of the law. That is, before the law, all are equal. Now, just go back to my earlier slide where I have said at the bottom that is there any rationale that ICDS are made applicable only in case of the assessee following mercantile system of accounting. So the class considered for application of the ICDS was only assessees following the mercantile system of accounting. The assessees who are following cash system of accounting, say doctor, chartered accountants, architects, professional like us, who normally follow the cash system of accounting, thankfully they are not, ICDS are not made applicable to them. So that this point was challenged from the perspective of Article 14 before the High Court. However, further the language is continued as it is, and still I don't get any answer that why it has been made applicable only to the assessees following the mercantile system of accounting, and why these ICDS are not made applicable to the assessees who are following the cash system of accounting. Because my point is that in cash system of accounting also we need to consider the closing stock. There could be issue of the retention money. So why these assessees are kept outside the ICDS? For that, I'm not getting an answer. If anybody from the audience can contribute at the end, then certainly it will be benefited. The wisdom will prevail over. So this was the point, and that was also part of discussion in the Delhi High Court in case of this writ petition. Then Article 19(1)(g) says that there has to be complete liberty in carrying the trade and profession. There cannot be any restriction put on anybody. So whether this ICDS to give the particular treatment to any particular item, whether it is a sort of putting the restriction, that was the challenge from the constitutional validity point of view. And last one, Article 141, 142, that the justifiable share of the tax can be collected, and if at all there is some injustice, then the Supreme Court can correct it, and therefore that was the Article 141, 142. And recently, in the context of this 148 litigation, we have recently once more we have noted this Article 142 and its impact. So with this, I am not a constitutional expert, but just as a part of the academic discussion before this gathering, I want to highlight the issues that were raised by the chamber before the Delhi High Court, and probably this may come at the rescue when a matter is litigated before the tribunal or CIT appeal or High Court, that what could be defense available to the assessee when challenging the treatment imported by the assessing officer in the computation of income by virtue of ICDS. So from that perspective, I thought it fit to touch upon this subject, though I'm saying I am not advocate by profession. I am chartered accountant. I am not a constitutional expert, but from the academic point of view, I just thought it fit to put it before you. With this, since we have to touch upon ICDS and tax audit report simultaneously, so let me take you back to the provisions of Section 44AB. 44AB was introduced by the Finance Act 1984. I recollect because at that time I was preparing for the exams of intermediate, and therefore it is strong in my memory that when this section was introduced, even I recollect the Finance Minister Vishwanath Pratap Singh was the Finance Minister at that time, and this was the provision for brought in with a certain objective. For the benefit of our discussion, I have just extracted the objective and intent of insertion of Section 44AB by Finance Act 1984 in the memorandum to the Finance Bill. It's very interesting because somehow it has a connection with the ICDS. And I want to put before the audience that, see, when 44AB one limb is there for certain objective in the assessment of the income, then what we are going to achieve by bringing the ICDS, and whether it's an additional burden. So let's look, let hear my thought, and then probably it will be one can derive the conclusion or come to the final analysis of that. So what the objective and intent of insertion of 44AB says? The accounts maintained by the companies are required to be audited under the Companies Act. Accounts maintained by the cooperative societies are required to be audited under the Cooperative Societies Act. There is, however, no obligation on other categories of the taxpayers to get their accounts audited. A proper audit for tax purposes would ensure that the books of account and other records are properly maintained and they faithfully reflected the income of the taxpayer. This should be carefully noted, that faithfully reflect the income of the taxpayer and claims for deductions are correctly made by him. This is the objective of the tax audit. Such an audit would also help in checking of fraudulent practices. It can also facilitate the administration of tax laws by proper presentation of the accounts before the tax authorities, and considerably saving the time of the assessing officers in carrying out the routine verification, like checking the correctness of the totals, verifying the whether purchases, sales are properly vouched or not. Now totals, etc., this is not relevant today because in 1984 there was no tally software or accounting software probably. So at that time this was included in the objective of the tax audit report also. But today vouching of purchase sales is probably relevant, but not the totals and all that. So to that extent there is a change. And the time of the assessing officer thus saved could be utilized for attending the more important investigational aspects of a case. So this was the object of bringing the tax audit report. Now somewhere the similar objective is the same, the above objective is on the same lines with the ultimate objective of the ICDS. This is to be noted because it has been given in the background of the this thing, that what is the purpose of bringing the ICDS. So it says, now I will read for from this thing, that to represent the fair, sorry, this is wrong. So ICDS were notified and issued for the purpose of what? For the purpose of reduction of litigation. Then minimization of the alternatives available for the disclosure of income. Certainty to the issues, like retention money, whether it's income on accrual basis or cash basis. So there has to be certainty of the issues. Or for example, provision for leave encashment, whether it's a certain liability or a contingent liability. How the stock is to be valued when the business of the partnership firm is discontinued or continued. So in order to bring the certainty to the litigated issues, minimization of the alternatives and reduction of the litigation was the main motto of bringing the tax this ICDS. Now I submit that the tax audit objective was also to bring some certain kind of clarity in the computation of income, though not exactly in terms, but somewhere it is near to that. So now the question to deliberate is that tax audit, one tool was there already in the hand of the income tax officer. Now ICDS has also been brought, which tries to improve the taxation of the income, that there should not be a revenue leakage. So now how to reconcile this, whether in a side by side in existence of the tax audit report, was there a need to have the ICDS? And I have tried to deliberate this, and I find the answer like this. See whether it is to be appreciated by you. In tax audit, if a particular provision of the law is not followed, or particular income is not showed on the basis of mercantile, despite of your following the mercantile system of accounting, the assessee has taken a divergent views and say, despite of filing the mercantile system, I don't want to offer those income because there is no certainty. I want to offer it on the basis of cash. So tax auditor, what will do? He will put the remark in the 3CD and he will disclose that qualification. His job is over. That means tax audit report qualification is sufficient. What will happen in the assessment that assessee will see? That is the end of the tax audit report. But in ICDS, it is made compulsory on the assessee to follow ICDS. So now the burden is not on the tax auditor. The burden is on the assessee. He has to give the treatment to a particular item as per the ICDS, if that ICDS is applicable. Now the assessee cannot tell that, boss, you are my tax auditor, whatever remark you want to put, you put it in there and finish it. Now for ICDS, it is the more onerous task of the assessee to file the return in terms of the ICDS, and he cannot ignore it. He cannot ignore it. Otherwise, there could be issues unless he's protected by the some judicial precedent, because ICDS itself says that if there is a conflict between the ICDS and judicial precedent, the judicial precedent will prevail. So therefore, I hope the audience must have understood the point that now it is more onerous task on the taxpayer to follow the ICDS. Jitendra ji, I hope I am audible and my presentation is also visible. If anything there is, just give warning to me, so that
definitely,
otherwise I can go on, because on screen I can't see I am seeing the participant 103, so that's fine. So I am confident that participants are there. Otherwise I will be speaking before the screen only.
No problem, sir. Yes, sir. Yes, sir.
So now applies only to the taxpayer following mercantile system of accounting, applicable to the profits, gains of business and profession, and income from other sources. Now, very obvious why ICDS are applicable only to the profits and gains of business or profession or income from other sources. Why it is not applicable to capital gain, to salary, to income from house property? Very simple answer. Because the salary charge is created on the basis of section 15 when the salary is due or received. If the salary is made taxable on due basis, then on receipt basis it can't be taxed. If salary is taxed on the basis of receipt, then on due basis it can't be taxed. The law is very clear. Similarly, income from house property, annual rental value, fair market value is the basis of charge created for the purpose of income from house property. You will get the deduction of interest from borrowing. You will get the deduction for municipal taxes. 30% what is for the repairs and maintenance, whether you incur repairs or not. You will get the vacancy allowance, all that. So the mechanism of computation of income under the head income from house property is so with a clarity probably, and straightforward mechanism is given for the purpose of computation of income under that head, and therefore there is no need to make the standard for that head of income. Similarly, for capital gain arises in the year of transfer of asset. So profit accruing or arising on the transfer of a capital asset is liable for under section 45(1). So for capital gain purpose, what we see the existence of such asset, transfer of asset, year of transfer of asset, and accrual of the consideration or receipt of the consideration. So within that, we have to given a fixed kind of mechanism, barring certain exceptions, that what happen if the capital asset is converted into stock in trade, if the capital asset is brought in by the partner, if the capital asset is withdrawn by the partner. And so multiple, the section 45.2 to section 45.6, they all deal with the typical situation, and recently section 9B and 45.4 also. But by and large, income from house property, income from salary, income from capital gain, the charge is more clear, and therefore probably there is no divergent kind of theme, differentiation of method of accounting like mercantile or cash. This problem arises only in case of income from other sources and profits and gains of business and profession, and therefore ICDS are made applicable only for the purpose of these two heads and not the remaining three heads. Taxpayers predominantly following mercantile method, but adopt the cash method only for small or significant streams of income may not be able to presume non-application. So this sentence is in a negative. That means predominantly you are following mercantile, a kind of hybrid. Now hybrid system is not permissible, but suppose largely you are following mercantile, and for only for few items in your profit and loss account or your books of accounts, you are following cash system of accounting, you cannot presume that ICDS is not applicable to. In other words, in that scenario also, the ICDS will be applicable, and tax auditor has to bear in this proposition in the mind. So here there is a ICDS and tax audit connection. The purpose of our topic is ICDS vis-a-vis tax audit. So this is the important point to be noted by the participant, that this ICDS has to be seen in the context of the tax audit report also. Then non-resident taxpayers may also have a concern on the computation of income of permanent establishment or a foreign branch. In that scenario also, they have to see whether the ICDS is required to be looked into for any item of the ICDS. Thankfully, it is not applicable to individuals and HUF who are not liable for tax audit. That means present to taxation employees, present to taxation assessees and small taxpayers who are individual and HUF and not getting their accounts under section 44AB, they are exempted from application of ICDS. Now, important declaration is made that if there is a conflict between the provisions of the Act and the treatment accorded by the ICDS, then the provisions of the Act will prevail. This is the principle they have declared, and that has to be kept in mind. Now, we are discussing the general principle of ICDS. What is the effect of ICDS? ICDS is to be considered for the purpose of computation of income. Because there was one of the argument was taken before the Delhi High Court in the case of that writ petition filed by Chamber, that whether ICDS notified required to maintain one more set of books of account by the assessor. In that context, they have given the clarification that ICDS is required only for the purpose of computation of income, and therefore no separate set of books of account is required to be maintained. Each ICDS has both computation and disclosure requirements. These are the two requirements. Revenue and expenses on which there is no ICDS prescribed will continue to be governed by the accounting standard or Ind AS. Unlike the ICA accounting standards, ICDS contains only main principles. There are no explanations given, no illustrations have been provided for our guidance, etc. The undefined words in the ICDS or undefined expressions under the ICDS, if there is some doubt, then you have to take their meaning from the Act. Because in Act, you will come the several judicial precedent where the words and phrases have been considered by the court. For example, what is meant by tax? What is meant by tax payable? What is meant by, you can say, is a reasonable cost? What is meant by sufficient cost? So if you come across any term where there is no meaning is provided in the ICDS, then you can provide it, then you can look into the act for the purpose of interpretation. And from the act also, if it is not clear, certainly you can search for the decision of the Supreme Court or High Court for interpretation of that particular term. Then how the disclosure is to be made. My wrong belief was, even while I was preparing for this lecture, somewhere it was, I was carrying a notion that disclosure is to be made only to the notes to the financials or something like that. But here, the disclosure can be made in the notes to the return of income. It can be made in the tax audit report. If while finalizing the accounts, though ICDS is not applicable for the maintenance of books of accounts, but you can modify your notes to account to the financials, or you can give the proper disclosure which will meet both the criteria, Schedule 6 criteria, Schedule 3 criteria of the Companies Act, or any other schedule applicable to the banks or insurance companies, etc. And simultaneously, if you can meet the purpose of the ICDS disclosure also, then that ICDS disclosure can also be on the face of the balance sheet and profit and loss account, etc., etc. For example, like stock, we give the disclosure that stock is valued at a cost or market price, whichever is lower. Or contingent liability schedule is not provided. The matter is in appeal and there is a tax demand of so and so, and the assessor has prepared an appeal, and this contingent liability is not provided, etc., etc., etc. So there are many places where the meaningful disclosure can be made, which will meet the disclosure requirement of the ICDS. Now, for the purpose of marrying the tax audit report with this ICDS, I have tried to put the relevant clause which is necessary to tag the ICDS number and tax audit report. It is for the better understanding while finalizing the tax audit report, which are the clauses where you can simultaneously look at the ICDS. So this is a wide notification 88/2016 tax audit report form number 3CD amended to include ICDS disclosure. The notification requires to disclose the adjustment, if any, made to the profit or loss for complying with the provisions of the ICDS. So ICDS number 1, accounting policies, clause number 14A, valuation of inventories, clause 14B, 35U. Construction contracts, no specific in the tax audit report. Revenue recognition, no specifically covered in the tax audit report. Tangible fixed asset, yes, clause 18, depreciation schedule. Effects of changes in foreign exchange rate, clause 13D, 13E, 13F, common clause. Then clause 18, 21A, government grants, clause 16B, 16E, security, no specific mention. Borrowing cost, clause 21A and 30, provision, contingent liabilities and contingent assets. Clause 21G, clause 25 and clause 26. So when you finalize the tax audit report, if you pay attention, if you focus on these clauses of your tax audit report, probably you will also address the issues of ICDS. What can be the comments on ICDS disclosure? Just for the sake of information, I tried to compile this, and therefore for the betterment understanding or just for the sake of knowledge and for the benefit of the participants, I have put down the screenshot. For example, ICDS number 1, accounting policies. The accounting policies adopted by the assessee during the year ended 31st March 21 have been disclosed in the note number showings of the financial statement. Change in the accounting policy, there is no change in the accounting policy. If there is a change, then you have to accordingly modify it. Then valuation of inventories, the accounting policies adopted by the assessee for measuring inventories have been disclosed in the note to the financial statement. The total carrying amount of the inventory so and so is classification is just appropriate to the assessee has been disclosed in the note. So just a sample kind of thing I have tried to mention it in my presentation. So I don't want to invest the time in this, because by and large we know how to make the disclosure and how to modify the language. But just for the sake of completeness, I have included the screenshot in my presentation. I have also tried to reconcile the ICDS and accounting standard of ICI. ICDS 1, accounting policies, disclosure of accounting policies. ICDS 2, valuation of inventories. There is S2, valuation of inventories. Construction contract S7, revenue recognition S9, tangible fixed asset S10, effects of changes S11, government grant S12, securities S13, borrowing cost S16, and provision for contingent liabilities and contingent assets, that is S29. Just for the sake of understanding, I have tried to compile this information. There is nothing specific to discuss on this, but just for the purpose of understanding and linkage or synchronization of the entire things, I have included this point. Next is fundamental accounting assumptions, because it is accounting policy is the first accounting standard. Competition, income competition and disclosure standard related to accounting policies. So what are the fundamental accounting assumptions? We have been looking at this assumptions since our intermediate course or even foundation course. Nothing more to talk on this, because all the participants are quite senior and or at least mid-senior kind of thing, who know all these principles. But I will just touch upon that going concern refers when there is no intention to liquidate, and when there is an intention to continue the business profession, etc., and there is for the foreseeable future, then that is called a going concern. Because if the going concern is damaged, then you have to open your eyes while signing the balance sheet, etc., and therefore that is very important. Consistency means from year to year or from one period to another, you have to follow the consistent accounting policies. If you follow the accounting policies in zigzag manner, then that will create a problem under the income tax. Consistency principle is very much recognized. One can recollect the Supreme Court decision of Radhaswamy Satsang 193 ITR, page 326, and Gopal Purohit case, which have again lauded the principle of consistency. That consistency is very important. Unless there is a change in the facts or change in the law, then consistency can be disturbed on these 2 points. If there is no change in the facts, no change in the law, then from year to year, we have to accord the same treatment to the computation of income or any item. For example, if leave encashment you are consistently you are claiming on the cash system, then unless otherwise the law asks you to change, or for any other reason which can be justified, otherwise consistency has to maintain. For that purpose, retention money, now it's a part of ICDS, so probably you can say ICDS part of 145(2). Earlier I was accounting for ICDS on a cash system. Now I want to recognize the retention money on the basis of mercantile because of to comply with the accounting ICDS. Then the consistency can be disturbed, because now law requires you to change it. So the point is, when there is a change in the law or change in the facts, this principle can be disturbed. Otherwise, from period to period, this consistency has to be maintained. Then is accrual. We know money, receipt is not important, money paid is not important. What is important is earned or incurred. Earned word is used in the context of income. Incurred word is used in the context of the expenditure. So that is the principle of accrual. Accounting policy means specific accounting policies and the methods of applying those principles. Consider what are the considerations which normally we apply for selecting the accounting policies. It shall represent a true and fair view of the state of affairs and income of the business. For treatment of transactions shall be governed by their substance and not merely a legal form. So now in many cases, the court also look at the substance of the transaction and not the legal form. What is difference between substance and legal form? Legal form means when you look at the agreement, contract, etc. That is the legal form. That may not be a reality. A reality is something different. So when you look in the reality and you find the real thing is something different and the documentation is giving the message something different, then form of the transaction is different and substance of the transaction is different. So they say that look at the substance and not at the form. The form can be misleading. For example, suppose take a case of deemed dividend. It's specifically covered by 222E. Suppose you want to give the dividend to the shareholder, but you want to avoid the DDT. So you will say, I will give the loan to the director or shareholder. So what is the substance? Substance is the act of giving the dividend. Well, form is act of giving the loan. This is called substance over the form. Or suppose take another example of sale and lease back. The A limited company has sold the asset to B company, and A company required that asset for carrying on the business. So again, it asks the B company, group company, to lease that asset, again lease back to that A limited. Means what happened? By way of sale, A limited has shown in the books that asset is sold to another party. While by leasing back that asset to A limited, that asset has come again into the business of the A company. So in form, it's a transaction of lease and sell. Sale and lease. But in substance, it is a separate. That, and this kind of arrangement was rightly plugged by the High Court, that it is for making the cash easily available to the A limited. Because by selling the asset, the A limited was facing the cash crunch. So A limited sold the asset, it realizes the cash, and again that sold asset is obtained on the lease, so that it has two purposes: continuation of use of asset and holding the cash balance. So it is a substance over the form. I think these two examples are enough for the audience to understand what is different between the substance and the form. So the policy has to be seen that it is governed by the substance and not by the legal form. Then it says expected loss shall not be recognized unless the recognition of such loss is in accordance with the provisions of any other ICDS. Normally, our prudence policy says that all expected losses should be accounted for, a provision should be made, but you cannot consider the expected profit because you cannot inflate the profit based on the expectation. Profit can be accounted only when there is a reasonable certainty or there is a possibility of realization. But for all losses, expected losses also, as a prudent man, you have to provide it in the books of account. Whether it's allowable under the Income Tax Act or not is a different issue. But this is they are specially saying that expected loss cannot be accounted for. Now there is one more issue that they are saying that mark to market loss or an expected loss shall not be recognized unless the recognition of such a loss is in accordance with the provisions of any other ICDS. I will come to this point again, but just for the time being, just mark this point in your mind that there is something on allowability of mark to market losses. Then if the occasion arises for change in accounting policy, then that accounting policy shall not be changed without a reasonable cause. Now here I want to point out that reasonable cause is a term used in section 273 of the Income Tax Act. When we argue the penalty matters, we say that there is a violation of a certain principle or a certain provision of the law, penalty is attracted, but section 273 of the Income Tax Act itself says that if the assessee is able to point out the reasonable cause, then penalty cannot be levied. For example, tax audit not done and there is a reasonable cause that chartered accountant was ill or assessee's business was under certain certain other custodian part, other government department has taken the custody of that books of accounts, etc. And therefore the tax audit could not be carried out. So many reasons, and we explain the reasonable cause. So we are fully acquainted with this term of reasonable cause. And for that purpose, there are number of judgments available. Even the FAQ 9 of circular that also talks about the reasonable cause. And for that purpose, one can refer to the Azadi Bachao Andolan case or Kalakriti case 253 Madras High Court, where and several other decisions on the reasonable cause. Here, why I have selected with this point, that there is one more term used which is known as the sufficient cause. When you ask for the condonation of delay in filing the appeal, you have to explain the sufficient cause. So see the two terms in the same act. One, it talks about the reasonable cause, another talks about the sufficient cause. Reasonable cause may be sufficient, but sufficient cause may not be reasonable. So both the terms are giving the different shade of meaning. So in the context of 249, condonation of delay, you have to see the sufficient cause, while in section 273, you have to see the reasonable cause, and ICDS talks about the reasonable cause. So if you want to change your accounting policy, you have to just explain the reasonable cause, that why it is called for, and not the sufficient cause. This is the point which I want to highlight. Then disclosure of accounting policies. All significant accounting policies should be disclosed. The amount of material effect due to change in the accounting policy is also required to be disclosed. The amount by which the item is affected by such a change shall also be disclosed to the extent which is ascertainable. If you are not able to ascertain the quantum of the effect, then you can't disclose it, or disclosure is required. But if you can ascertain it, then the impact has to be disclosed. Where such amount is not ascertainable wholly or in part, that fact should be indicated in your disclosure that you are unable to find out the impact of this change in the policy. Now there could be a situation that by change in accounting policy, there is no impact in this year, but that can have the impact in the latter years. So this fact should be sufficiently brought on record, that the change is made in the accounting policy of the organization, which has the material effect in the latter previous year, and the fact that such a change will be appropriately disclosed in that year in which the change will have the material effect for the first time. This disclosure has to be made. Then sometimes there is a wrong notion. If we don't follow the ICDS or we don't follow the accounting standard, then we sometimes presume that disclosure is the remedy for the wrong done. But that is not the correct understanding. Mere disclosure may not save you from any wrong or inappropriate treatment given to the item in the computation of income. Meaning thereby, many chartered accountants are under the belief that I have not given the correct treatment, but I have disclosed it. So I'm raising my hands. Or assessee say, yes, we have done wrong, but we have given the disclosure. So what is wrong? So the wrong treatment cannot be met only by making the disclosure. It is not correct. You have to really give correct effect to that item and make a then disclosure. So this sentence is very important as such. Then fundamental accounting assumption to be disclosed only if the fundamental accounting assumptions have not been followed. If they are followed, then it is not to be disclosed. In a tax audit report, the tax auditor is required to report the accounting policies adopted by the assessee as well as changes in the accounting policy as discussed in earlier slide. Refer clause 13F of the tax audit report. For the earlier, I had touched upon the issue of mark-to-market losses. There are already some decisions available on this point, because all along the AO was taking the view that mark-to-market losses are contingent losses. Those are not ascertained losses, and therefore those are not allowable. However, the Supreme Court has considered all these aspects in the case of Woodward Governor, then Oil and Natural Gas Company, Orient Cement. Recently, Kolkata Tribunal has dealt with this issue that mark-to-market losses are allowable losses, and then Bangalore Tribunal decision of Acer India. I am bringing this because there is a specific mention in the ICDS that mark-to-market losses will not be allowed. So, however, the judicial precedent are holding contrary to this, and we have been told that if there is a conflict between the ICDS and provisions of the Act or judicial precedent, then provision of the Act will prevail, or the provision of the judicial precedent will be binding and not the ICDS. So, from that perspective, I want to point out this point. Then materiality concept, then change in accounting policy only permitted by the reasonable cause, etc. I have already touched upon those points. So this slide I can skip. With this, let me move to the valuation of inventories. What is meant by inventory? Inventories are the asset which are held for the sale in the ordinary course of business. WIP, in the form of material or supplies to be consumed in the production process or in rendering of the services. So while considering the particular inventory list or considering the inventory for the purpose of balance sheet, these tests have to be applied. If that item is falling in this, then that is to be considered as inventory, as asset. Otherwise, that item is not part of inventory, and that is to be supposed to be written off to the profit and loss account. Because assessees are nowadays are very wise to manipulate the books of accounts to inflate the profit. They may include any item which is not forming part of the inventory as per this criteria. So instead of writing the profit and loss account, they may include it in the finished goods or WIP raw material. So you have to keep your eyes very open, and you have to see whether these qualities have been tested. If that is not fitting either in the definition of finished goods, which is not held for the sale in the ordinary course of business, if it is not for the production process, if it is not part of raw material, then that expenditure has to be written off to the profit and loss. Net realizable value is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. We are aware of this NRV, so I'm not wasting time on that. Inventory shall be valued at a lower of cost or NRV. Now, what is the cost of inventories? That is also given how to measure the cost. Cost comprise of all cost, purchase price, cost of services, conversion cost, cost incurred in bringing the inventories to their present location and condition. Purchase cost will include purchase price, duties and taxes, freight inward, other direct expenditure attributable to acquisition of inventory, trade discount, rebate should be reduced. Many, I have seen the many electrical dealers or etc., where they receive the several incentives on achievement of the turnover, etc. So whether this turnover, receipt of rebate, it is the reduction in the purchase cost or indirect income. ICDS says it has to be reduced from the purchase cost. Then cost of service include labor, other cost of personnel directly charged. Technical guidance note by ICI, ICDS 2 is not applicable to the service inventory. Then what is cost of conversion? It includes cost directly related to the production and systematic allocation of fixed and variable overheads. It's a costing kind of subject. So, and obviously our costing knowledge is very limited for the purpose of appearing in intermediate and final exams. So let's not take a deep dive into this. A small touch and go kind of reference will be enough for us. Then byproducts, scrap or waste material or material, these should be measured at a NRV, and value of these items should be deducted from the cost of the main product. Interest and other borrowing cost should not be included in the cost of inventories unless as per the ICDS 9 on the borrowing cost ask you to include this. So this is the important. There is certain litigation on this, which I'm referring to in my some other slides. It's a very interesting point, and I have actually faced the live case study on the interest and borrowing cost. Then certain costs are to be excluded: abnormal wasted material, labor, other production overheads. Storage cost. I want to talk about something on the storage cost. They say that storage cost should be excluded unless those costs are necessary in the production process prior to further production stage. So the poser which I am raising is, can there be a dispute to add the normal storage cost or and exclude the abnormal storage cost? Storage cost is to be considered as a selling overhead, and therefore to exclude is the correct proposition. So now let me come back to my questions. I am saying, suppose the storage cost is normal, whether it is to be included for the purpose of inventory valuation. The ICDS says no. Can abnormal cost be included? Suppose in the last 2 years, Corona, many times in the first lockdown or first wave, many manufacturer or the distributor were not able to move their goods. Complete transportation was closed. So you can imagine how much storage cost they might have incurred. So whether this storage cost, which was abnormal, is to be written up to the profit and loss account, it is to be treated as a part of the inventory. I think the correct logical answer is, because storage cost is considered as the selling and distribution overhead, and therefore that cannot be included as a part of the inventory. And I think that is the correct legal proposition. Whether it's a normal or abnormal, it will not make any difference, because in Corona, many businesses might have incurred the abnormal storage cost that has to be written to P&L, or normal cost is anyway, it's to be written out to the P&L and cannot be included as a part of the inventory valuation. Administrative overheads do not contribute to bringing the inventories to their present location, like printing, stationery, telephone, office rent, shop rent, etc. And therefore, these have to be excluded while valuating the inventory. Selling cost is any case to be excluded. Now, certain important point and litigative issues. Section 145A start with a non-abstantee clause and does same override the provisions of section 145 read with ICDS. 145A, you know that gross valuation, tax, duties, etc. are to be valued, purchase, sale, inventory on a what we call as a gross basis and not a net basis. So this is 145A start with non-abstantee clause. So whether it will override the ICDS, we have to see what the AOs and further litigation is on may happen in this. But I think when there is a specific provision on 145A which talks about the valuation of inventories and purchase and sale, then there will be the settled principle of the law that specific provision will override the general provision. So 145A is a specific provision. 145 read with ICDS is a general provision. So we can come out with this proposition that the specific versus general. Then change in the method of valuation. If again there is a reasonable cost, and if you are able to establish that what the method of valuation I was following is wrong, and now in terms of the correct, true and fair view of this thing, I have to change my valuation method, then that is permissible. However, you have to give the reasonable cost for that. Then I was referring to the ALA firm decision of 189 ITR, where it was a case of dissolution of a partnership firm, where they say that business is discontinued, this is the provision of ICDS, which says that in case of dissolution of a partnership firm, AOP BOI, notwithstanding whether the business is discontinued or not, the inventory on the date of dissolution shall be valued at the NRV. This is the prescription of the ICDS. While judicial precedent on the hands of Supreme Court in 189 ITR, they say that the NRV is to be applied because the business was discontinued. The logic was very simple. The business is discontinued. That means you are selling the inventory, and therefore it is to be valued at the NRV. While this principle was again distinguished by the Supreme Court in Sakti Trading Company's case 250 ITR 871, where the Honorable Supreme Court has held that ALA firm decision is not applicable and held that a valuation to be made on the cost or net realizable value, whichever is lower, since the business was continued post dissolution. Because even though there is a change in the constitution of the firm, the business was continued, and in that scenario, it is permissible to value the stock at the cost or net realizable value, which is lower. So this is the latter enactment which will prevail. However, this position is not considered in the ICDS, and this was the one of the point of discussion before the Delhi High Court while challenging the ICDS. And the Delhi court has appreciated this point of view that ICDS is silent on this. But despite of that, I don't see any change in the language. But still, we can argue that when there is a settled principle of the law, then ICDS will not override. Otherwise, many times when I see that because of the inventory valuation, there is a debate or there is a lot of litigation. So there, I always refer to the Chenru Sampatram K 24 ITR. It says that the valuation of the unsold stock at the close of the accounting period is necessary part of process of determining the trading result. It cannot be a source of income because stock is carried forward to the next year, and next year you will get the deduction. So per se, the closing stock cannot be regarded as a source of profit. So really, there should not be any litigation. However, the fact remains that for the correct disclosure of the profit, you have to value the stock. Otherwise, when there is a timing difference, etc., this Chenru Sampatram case is linked on the very important principle that it cannot be regarded as a source of profit. Valuation of opening inventory and the closing inventory has to be on the same basis. No need to say that. Newly commenced business, cost of inventory on the day of commencement of business shall be opening inventory. Contribution of asset as a stock in trade by the partner of the firm. No specific guidance available for this basis when a capital asset is brought in by the partner as a stock in trade. For that purpose, section 45(3) also does not apply because that talks about the capital asset converted into stock in trade by the same assessee. Here, the assessees are different. Partner has converted its capital asset into stock in trade of the firm. So in that situation, the one can argue that the 45(3) is not applicable. Or if at all one has to talk about the cost, then the value credited in the books of the partnership may arguably constitute the cost of that stock in trade. In tax audit report, section 40B talks about, clause 14B talks about deviation from the method of valuation prescribed under section 145A and the effect of the same on the profit and loss account. Then accounting policy adopted and the carrying amount that has to be reflected under the clause number 13F. Clause 35 requires the tax auditor to give the quantitative details of raw material and finished goods. That takes me to the next ICDS 3. Jitendra ji, just I'm taking a 2 minutes break to have the water. Is it okay?
Yes, sir, no problem.
Sorry for pause. I'm back. Jitendra ji, is it fine?
Yes, sir. Please continue. No problem.
So let me take to the ICDS series, which talks about the construction contracts. Construction contract is a contract specifically negotiated for construction of an asset or combination of assets. Those assets are maybe interrelated, interdependent, and includes contract for rendering of services which are directly related to the construction of the asset. Contract can be for the destruction and restoration of the asset also. Now, contract revenue should be recognized only if there is a reasonable certainty of the ultimate collection. Now, contract revenue comprises of initial amount of revenue agreed in the contract, including retention. This is creating a problem. Retention money and variation of the contract work, claims, and incentive payments. Writing of the contract revenue already recognized to be considered as an expense and not an adjustment to contract revenue. This is important point. Sometimes what happens if the contract revenue is not recognized, then for unknown purpose, if the same amount, instead of showing the bad debt, if it is reduced from the gross revenue, then that is a complete misleading picture. Even though the ultimate impact on the profit will remain the same, but it is not the correct practice, correct disclosure. So this point needs to be taken care of. Now what happens? Suppose a case study is considered for retention money. Suppose during the construction 90% work is completed, 90% consideration is paid. Retention money payable after 2 years is 10%. Total 100%. Now stage of completion, say at the year end one, assume 40%. The question arises, assuming the total consideration of 1 crore, that is 90 plus 10, what is the amount of contract revenue to be booked? Rupees 40 lakhs or rupees 36 lakhs? Because now it says the retention money, which is payable after 2 years, that is also to be considered as an income. So 90 plus retention money 100, 90 is net of retention money. So actually you have to consider 100, 40% work is completed, so 40 lakhs rupees. And if one would take excluding the retention money, then 36 lakh is to be accounted. Then this could be a point of litigation. As per the earlier precedent, the accounting policy disclosed and consistent accounting is followed. Several courts have taken a view that retention money, since there is a uncertainty for collection, because suppose tomorrow, if the contractee finds some faults in my contract, if I have not made the guarantee, and therefore if it deduct my retention money, they do not pay me back, then how the income is to be shown? The question is obviously litigated, but with the ICDS, if really one wants to take the view, then 40 lakhs will be the correct answer. But litigation can be there. Cost to be, what is the cost which are comprising? Costs that directly relate to specific contract, costs that are attributable to the contract in general, and allocation of particular cost, allocated borrowing cost as per ICDS, and cost incurred in securing the contracts. That is also included as a cost of contract. There are certain key points that during the early stages of contract, where the outcome of the contract cannot be estimated reliably, then cost revenue to be recognized only to the extent of cost. When the stage extend beyond 25%, then percentage of completion is to be followed. By and large, we are aware of the percentage completion and completed contract method. So I don't want to dwell upon in detail on this, because there are certain other important issues on borrowing costs, etc. And there are 54 slides, and we are on slide number 24, and I'm left with a half an hour. So wherever possible, with your kind permission, I will skip that portion, though it is part of my presentation, which one can refer if interested. Applicability to the real estate developer was again a very controversial issue. They say that pre-ICDS S7 does not apply to the real estate developers. and there are quite tribunal decision, Jaipur Tribunal, Mumbai Tribunal. Post ICDS, there is a FAQ number 12 of circular number 10 of 2017 dated 23rd March 17. In absence of any specific ICDS for real estate developers, relevant provisions of the Act will apply, and ICDS in general, that means revenue recognition, etc., or government grants, or borrowing cost, etc. As per other ICDS will apply, but there is not a specific ICDS for the real estate and developers. ICDS 3 does not expressly exclude construction by builders and developers, nor is it comprehensively enough to cover the unique characteristics of the revenue from the real estate transaction within their scope. Hence, in order to bring the clarity and uniformity in computation of income from real estate transaction, CBDT introduced a draft ICDS on real estate transaction in May 2017, which is largely driven by ICAI guidance note on real estate transaction. However, the final ICDS is still not released. The tax audit report, while there is no specific clause in connection with the ICDS for the disclosure in tax audit report, what is to be disclosed is the contract revenue, contract cost, and advances received and retention money. In clause 13A of tax audit report, including the method used to determine the stage of completion, that is to be disclosed. Then important is very common is revenue recognition, ICDS 4. Revenue is the gross inflow of cash, receivable and other consideration arising in the course of ordinary business or ordinary activities of the person from the sale of goods, from rendering of services, from the use by others of the person's resources, which can use those resources can yield interest, royalty, dividend. Interest mean funds loaned out, royalties mean provision of drawings and designs, etc., technical guidance, dividend means shareholding. So these are the person's resources which are exposed for earning the income. In an agency relationship, the revenue is the amount of commission and not the gross inflow of the cash receivables or other consideration. Now, sale of goods, revenue shall be recognized when the seller of the good has transferred to the buyer the property in the goods for a price, and all significant risk and reward are transferred to the risk and reward of the ownership have been transferred to the buyer, and the seller retains no effective control on that. Revenue shall be recognized when there is a reasonable certainty of collection. When there is a lacking of ultimate collection with a reasonable certainty at the time of raising any claim for escalation of price and export incentives, revenue recognition in respect of such a claim shall be postponed to the extent of uncertainty involved. However, practically, I don't see any much importance for this, because in normal scenario in our day-to-day life, we never see that we will not recognize the revenue on the sale of goods. If tomorrow that sale of goods, consideration for sale of goods is not recovered, then we can always claim it as a bad debt by virtue of section 36(1)(7) or whatever it may be. So really, why ICD is so saying that if there is an uncertainty in collection of sale of goods, then that should not be recognized. I feel a little feel that this is practically of no importance, but I don't know whether in the group company, etc., it may be possible that you from the beginning you know that there is uncertainty, and in that scenario probably you may say that this is the revenue is not to be recognized. However, I think a very strong documentation is required if you are taking this view that the sale is made, sale of goods is made, or sale of services is made, and the consideration is not recoverable, or there is a huge uncertainty for collection. I think a very strong documentation will be required for this. This ICDA is not materially different from AS9. That is to be kept in mind. Then sale of services include intermediate number of acts, services with milestone. There can be two types of this. In certain services like software development, etc., certain milestone are decided that you can raise the invoice after this milestone. You will be paid 35% after this. You will be paid 50% of this. So in that way, the revenue can be recognized. Then interest, we know that interest accrues on time to time basis, and interest on refund like tax, duties, etc. Those are because of the uncertainty. Those are always we offer on the basis of receipt, and that is, I think, recognized by ICDS 4. There is no damage as such. Then royalties shall be taxable in accordance with the terms of contract. Whenever the royalties are fixed in terms of for supply of design or drawings, etc., there is always an agreement with the party providing the technical design, drawings, and service, and therefore, what is the terms of payment or royalty in that contract, that will decide the point of accrual or income or receipt of income. And according to that contract, you have to see whether your client has properly recognized the revenue. As a tax auditor, it is more appropriate to recognize the revenue on some other systematic and a rational basis. Dividend shall be taxable as per the provisions of the Act. Now just take a simple case study. Suppose A Limited is an investment banker who usually enters into contracts with the client on success fee model, wherein the income, wherein the fees become payable only on the conclusion of the deal. At each year end, there would be open mandate from clients for which efforts to find out suitable buyer or seller would have been put in. But the fate of the deal is uncertain. No inventory is recognized at the year end for the cost incurred on open mandates in view of the uncertainty of the deal in the books of accounts. How to compute the taxable income as per ICDS is a question posed before you. Department may argue and impose that the percentage of completion method to recognize revenue. However, assessing can argue that accrual of the income or reasonable certainty is the income that arises only upon the conclusion of the deal, and there is no maturity or accrual of the revenue over the period to defer this. So spread of the revenue. So in practical reality, there can be a lot of examples like this, where there can be a debate on accrual of the recognition of the revenue. Now, what disclosure is required in tax audit report? There is no specific clause on this. However, the ICDS says that you have to disclose the revenue recognized, revenue not recognized due to lack of reasonable certainty, surveyed contract in progress, advance received and retention during the year. Clause 13A of tax audit report, including the method used to determine the stage of completion in case of the service transactions. This is the tax audit angle point of view. Next is ICDS 5, tangible fixed assets. Tangible fixed asset, as we know, section 32 also, that asset being land, building, machinery, plant, furniture, which are used for the purpose of production or carrying on the business, but not held for the sale. If it is held for the sale, then you have to go to inventing. If it is not for held for sale, then it's a fixed asset, tangible fixed asset. Then actual cost of the asset will include purchase price, import duties, other taxes is not recoverable, price adjustment, changes in duties, exchange fluctuation. As per ICDS 6, expenditure incurred on test and trial runs, expense that increases the future benefits from the existing asset. What is to be excluded? Administrative overhead not related to specific asset to be excluded, trade discounts, rebate, expenses incurred after commercial production to be excluded. ICDS in the context of AKFU 15 suggests that any expense between the successful trial production and commercial production is to be treated as a capital in nature, because this is very important. And recently, just of the context, I faced a lot of litigation on this in one of the client's case. So these are very crucial points for what is the date of trial production, what is the date of commercial production. What was happened in a particular case, just as an example, not very relevant for this lecture, but very interesting issue. The assessee has claimed the trial run production in the profit and loss account, and there was a search action on the client. The department said that this trial run production, we found from the seized document that there is a defect to trial production. That means your system is not established. Since there is a defect in the trial production, so your commercial date of production is not achieved and your commercial production has not started. Therefore, in view of the document seized during the course of search, the department alleged that this expenditure which you are written up to the profit and loss account needs to be capitalized. So if there is a situation like this, then probably here you have to take the cognizance as per ICDS 5 also, that what is to be treated as a capital and what is to be written up to the profit and loss account, for which this explanation will certainly matter and we have some relevance. It's a Pune tribunal decision. Just 2 months ago it was published in the tax audit report. I don't exactly recollect the name of the case. So this is the issue which one has to take care. And incidentally, there was one more interesting one, and is that certain adjustment which were made for the during the course of such declaration for the normal computation of income, those were also forced by the department to consider for the purpose of MAT. So that issue has also been discussed, but that is not relevant for today's discussion. So I'm not going into those propositions, but it's an important point to consider the expenses incurred during the trial production and commercial production to recognize whether as a expenditure of tangible fixed assets or to be written off to the profit and loss account. The tax auditor has to report details of the actual cost of addition, while calculation, depreciation, etc. We are aware of schedule clause 18 of the tax audit report, very familiar. So there is nothing to discuss much. Foreign exchange fluctuation is a foreign currency transaction. We know how it is to be converted, closing item, then item at the date of the transaction, monetary items, non-monetary items, how those are to be carried forward. And we have already dealt with this when for years together by virtue of S11. So monetary items means the money held and asset to be received or liabilities to be paid in the fixed amount of money. That is cash, receivables and payables. Foreign currency transaction is normally when you buy and sell goods, those prices determined in foreign currency. Borrowed funds or lending funds, amounts payable, receivable are denominated in foreign currency. That becomes a party to the unperformed contract or forward exchange contract. And non-monetary items are the assets and liabilities other than monetary items. Very simple definition. In this context, apart from that closing rate and how to convert that I'm not going to deal with. The only one important aspect on which I want to draw the attention is the provision of section 43 capital A. Now there is one more change in the act by virtue of 43 AA. But before that, 43A I will deal with. 43A says, or rather 43A provides, where it says that where an assessee has acquired imported asset and in consequence of a change in the rate of exchange during the previous year, after the acquisition of such asset, if there is an increase or reduction in the liability of the assessee as expressed in the Indian currency at the time of making the payment toward the cost of the asset or repayment of the loan for acquiring such asset, the corresponding foreign exchange difference is to be adjusted in the actual cost of the asset. And once it is adjusted in the actual cost of asset, then obviously you will be entitled for the purpose of depreciation on that. Here important is that the asset is imported to India. If there is a foreign liability, but asset is not imported, then 43A doesn't apply. For applicability of the 14A, there is a twin condition that there has to be liability for the asset, which is expressed in Indian currency, and there is a variation in the liability, and the asset is imported. If the asset is indigenous asset, then 43A doesn't apply. However, I believe now there is a amendment in the act, and for indigenous asset, 43 AA will apply. That also talks about taxation of foreign exchange and fluctuation in the foreign currency. This point is to be considered very carefully while dealing with this. Let's take a simple example that A Limited purchased a plant and machinery from USA for $1,000 in the month of February 20, when the exchange rate was again $1 75. So initially it will record the transaction at 75, fixed asset account debit 75 to creditors account 75, then creditors account will be paid by the actual payment. Now suppose on 31st March 20, after 1 month, if the plant and machinery will be carried at 75,000 being non-monetary item, while the liability will be restated at 76,000 rupees because the rate of exchange fluctuation has been changed from 75 to 76. In June 20, other than the closing rate of 31st March 20, in June 20, suppose the foreign exchange rate is further changed. Suppose 77,000 is paid to the creditor. Then now there will be exchange loss of 2,000 because 77,000 at the time of payment minus initial liability recognized 75. So 2,000 will be accounted for. Out of that, 1,000 is already accounted on 31st March 20, and 1,000 remaining 1,000 will be accounted on the month in the month of June. And this 2,000 rupees by virtue of section 43A is to be added to the block of asset for the purpose of claiming the depreciation. However, as I said, if the no asset is imported, then section 43A will not apply. The tax auditor has to report this in depreciation schedule 18. That takes me to the government grants. Government grants are assistance by government in the form of cash or kind to a person or government assistance. We know the nature of government subsidy and all that. There are a lot of decisions. Most controversial point on government grants. Government grant refer to the state government grants or the central government or agencies and similar bodies, whether local, national or international, because there can be subsidy from the international government as well. Now the different treatment. See in the first table, what is the nature of the grant, and in the second, how the treatment is to be accorded. For example, if the grant is for a specific depreciable asset, then you have to reduce it from the cost of the asset. Read with explanation 210 to section 43(1). If it is related to the non-depreciable asset, then deferred income over the period matching with the cost of meeting the obligation or on upfront basis. If not directly related to the assets acquired, then reduce from the actual cost or WD of the block of asset on a pro rata basis. If it is related to the compensation for loss or compensation for expense, then recognize is as a revenue income in the year it is receivable. Non-monetary asset given at a concessional rate, account asset at a reduced cost because it's a concession given. And any other government grant which is received, for example, promoter contribution, etc., deferred income over the period matching with the cost of the obligation. So these are the different scenarios, nature of the asset and treatment to be accorded in line with the ICDS. I will call you in the lecture. So these are the different scenarios and purpose of the grant where you have to consider the accounting treatment. Now recognition as per the ICDS depends on the reasonable assurance or satisfaction of the conditions and receipt of the grant. However, ICDS says that it cannot be postponed beyond actual date of receipt. So once you receive the grant, you cannot say that I have not satisfied the condition. That plea is not available to you. Once it is received, then you have to recognize it as an income, because when you are received, then the income tax officer will definitely say that since you have received, that means you have fulfilled all the conditions imposed by the grantor, and therefore it is to be recognized as an income, or you have to reduce it from the cost of the asset depending on the purpose of the grant. The important case study is, suppose A Limited received the subsidy worth ₹10 crore in the year 1 through the stamp duty exemption to buy the land in the backward area pursuant to the package scheme of incentives offered by the government. A Limited has obligation to set up an industrial unit and provide certain level of employment over a period of 5 years. This is the purpose of the grant subsidy. How will A Limited treat the stamp duty exemption of 10 crore received from government for meeting the cost of the land? Will it be taxable upfront year 1 or over the period of matching cost, say over the 5 years? ICDS requires subsidy related to non-depreciable asset to be recognized as income, because land is a non-depreciable asset, over a period matching with the incurrence of the related cost. Income definition under section 224 clause 18 is amended by the Finance Act 2016 to cover all subsidies, and hence it is not possible for the A Limited to argue that this stamp duty exemption is a capital receipt, and ICDS will not apply because the law is now amended. So this kind of examples you have to consider. However, in practical reality, I have dealt with one case that the grant or subsidy was received from the foreign government, and the Mumbai tribunal has held that explanation 10 to section 43(1) does not apply. It applies only if the grant is received from the Indian government or any Indian authority. Section 43 explanation 10 does not apply to the foreign subsidy. This is the only decision available in case of the foreign grants. It is just for the sake of knowledge to note this decision. Then what is disclosure is required? I think any deduction from the cost of the asset as per the treatment given in the earlier slide. There is a tax audit report, clause 13A, 18C, 16E, because it will run through depreciation schedule, accounting policy, etc. And so more than at one place, the disclosure will come in one form or the other form. Securities, I think considering the availability of the time, it's not very practical. So I would like to skip this securities part, but rather than I would like to consider the borrowing cost, because it is a more commonly required for all of us. Jitendra ji. Hello.
Yes.
There are 10 standard ICDS. We are on ICDS 9. With your permission, I skipped a security contract, and the last one, contingent asset, contingent liability. Also, I will escape. I will finish this one, and I think we should give some time to the participant if there are any questions. Is that fine?
Yes, sir. Yes, sir. Please.
Yeah. Thank you. So ICDS 9 is on talking about the borrowing cost. Borrowing cost include interest and other costs. For example, commitment charges on borrowing, amortized amount of discount or premium, amortized amount of ancillary cost incurred in connection with the arrangement of borrowing, finance charges in respect of assets acquired under the finance lease or under the similar arrangement. What is qualifying asset? Qualifying asset means land, building, machinery, plant or furniture being tangible asset, know-how, copyright, patents, intangible assets, inventories that require, this is important, inventories that require a period of 12 months or more to bring them to a sellable condition. The similar kind of qualifying asset definition you will find in A16. And actually, I have dealt with a practical scenario before the tribunal while dealing with this situation of qualifying asset. That is covered in my next presentation. Recognition is borrowing costs that are directly attributable for the acquisition, for the construction, for the production of a qualifying asset shall be capitalized. Capitalization in the context of inventory means adding the borrowing cost to the cost of the inventory. Common principle. Calculation of borrowing cost eligible for capitalization and commencement of capitalization. If there is a specific borrowing for a particular project or particular asset, then that will be capitalized and no formula is required. However, if the capitalization is, there is no specific borrowings, then certain formula is given. I don't want to go into the mathematical part of it. Rather, I would like to deal with the certain situation. Now, what has happened was that we are aware that capitalization of the borrowing cost shall cease when such a qualifying asset is first put to use, or when all the activities necessary to prepare the inventory for intended sale are complete. Then that ceases to be the qualifying asset. So it says inventories are qualifying asset. Inventories means stock in trade. That is in case of when the situation I faced was the case of the builder and promoter. So the AO said that you are acquiring land for your development of projects. Your projects are under construction, and those construction development or project is prolonged beyond 12 months, and therefore that is a qualifying asset. So they are saying inventories are qualifying asset only if they require 12 months or more to bring them to sellable condition. So taking the clue from S16 and obviously now ICDS also, the AO took a stand that in your case, the projects are not completed within 12 months, and therefore whatever the interest on borrowing crores of rupees you are debited to the profit and loss account is liable to be capitalized. That was his point. The matter went to the tribunal. The tribunal considered this case in the case of Kumar Company, Pune Tribunal, and we heavily argued on section 36(1)(3). 36(1)(3) at that time was saying that interest on borrowing capital for the purpose of expansion of the business or expansion of the business or acquisition for the purpose of asset. We interpreted that asset means a capital asset, and inventory and stock in trade in the hands of the builder is not a capital asset. So therefore, even though so qualifying asset means a capital asset, and qualifying asset term cannot be read in the context of the stock in trade. The tribunal has appreciated that issue and held that the interest cannot be disallowed on the basis of capitalization. While around this conclusion, the tribunal has relied on the Taparia Tools 372 ITR, Bhor Industries, Wall Street decision, Dhaka Developers Pune Tribunal. Further, the Supreme Court in the case of Taparia Tools has held, because the revenue has quoted the decision of 225 ITR, this Madras Industrial Development Corporation, where the interest on debenture was spread over the period of debenture. So there they have held, or some lease rent spread over the term of the asset. So in Taparia Tools, the Supreme Court has held that under the Income Tax Act, there are only two concepts, either revenue expenditure or capital expenditure. There is no concept like deferred revenue expenditure. In Madras Industrial case, it was the assessee's choice that he wanted to defer the expenses. Therefore, the Tribunal and High Court allowed the deferment of the expenses. Otherwise, under the Income Tax Act, there are only two concepts, either fully capitalized or full revenue. There is no concept of deferred revenue expenditure. So I think this was an interesting point, and incidentally I have dealt with this, and therefore I thought that to bring it to the notice of the participant. FAQ 22 suggests that capitalization to be done on asset by asset basis. Since the specific provision of the Act overrides the provisions of ICDS, it is clarified that the borrowing cost to be considered for capitalization under the ICDS 9 shall exclude the borrowing cost which are disallowed under the specific provision of that. Capitalization of the borrowing cost shall apply for that portion of the borrowing cost which is otherwise allowable under section 36(1)(3). Because the interest which is already disallowed, you cannot ask me to capitalize it because there is no benefit on that. Then tax auditor has to disclose certain adjustment in the relevant clauses. with this, I think I will stop over this. Only 2-3 sites are left. So, and contingent asset and contingent liabilities, I think we are quite aware about this, and not much to discuss on that. So with your kind permission, I take a pause here and I hand over the mic to the organizer or Jitendra, please.
I request the members, those who are having any query, request to ask. Any member is any query? I think, sir, the topic is explained very nicely. So the members is not having any.
So there can be two, Jitendra. One,
Vishal, sir.
assuming that the topic is explained very nicely and so no question, or topic is explained in such a bad manner that nobody have understood that what to ask.
I think, sir, the first option is.
Thanks for your compliments.
Yes, sir. Sir, it's a proud privilege, sir, to give vote of thanks on behalf of Nashik branch. So thank you, sir, for taking your valuable time and giving guidance on ICDS. So you thoroughly cover the area with practical cases. It will definitely help the members while carrying out their tax audit. Once again, thank you, sir. With this, I declare the session is over now.
Thank you very much.
Thank you, sir. Thank you, sir. Sir, in chat box, there is a message. The session is very informative, well explained.
Thank you very much. Thank you very much.
Thank you, sir. Thank you, sir.
Okay. May I leave?
Yes, sir. Please, please. Yes.